Have you ever wondered how hedge funds make billions of dollars even when the market crashes? Unlike retail investors like you and me, these firms don't just hodl and wait for things to moon. They use highly sophisticated, battle-tested strategies that give them an edge over everyone else. And in this video, I'll be revealing the 6 main strategies used by hedge funds. Now, before getting started, if like me, you're fascinated by the world of investing, you may want to check out the Applied Value Investing Certificate program being offered by Wall Street Prep and Wharton. This program teaches you how to apply the principles of value investing with the sophistication of an institutional investor. And the program is taught by Wharton professors and keynote speakers, including Oaktree's founder, Howard Marks, who is one of the most famous investors in the world. I highly recommend you check out his podcast, The Memo. Through this 8-week-long program, you'll learn about the core concepts behind value investing, such as market efficiency, intrinsic value, process-driven value investing, and a whole lot more. And you'll also gain access to an exclusive global network and special in-person networking events. And so whether you're an individual investor or a student trying to break into hedge funds, this program will give you the fundamental knowledge you need to invest, like the father of value investing, Warren Buffett himself. And if any of this is of interest to you, be sure to use my code rareliquid to get up to $500 off. And I'll leave information and links for everything discussed in this video's description. All right, with that said, let's first go into what hedging actually means. As the name suggests, hedge funds use hedging to manage risk by making investments that act as a counterbalance to one another, and they do this by taking a primary position, long or short, and simultaneously opening an opposite position that will either still net a profit or limit losses if things take an unexpected turn. If this is confusing, don't worry because I'll be going through examples when we discuss each strategy. But what's important for you to know is that the goal with hedging isn't necessarily to eliminate risk altogether because that's impossible, but instead to reduce exposure to broad market movements and protect against downside risk. And as a result, hedge funds tend to do better than the market during downturns. To complicate things though, there are risks to hedging too. Placing the wrong bets could lead to losses on both sides to the trade. Over-hedging can erode profits and result in lower returns. And many funds borrow money to hedge, which amplifies risk if things go south. Alright, with that said, let's go into the hedge fund strategies, starting with long-short equity funds, which is the traditional strategy when you normally think of hedge funds. Long-short funds take long positions on undervalued stocks they think will go up, and short overvalued ones they think will go down. Investments are made across different sectors, markets, and geographies, such as in emerging markets, focused only in the US, in the healthcare sector, and etc. And this strategy is not meant to be market neutral, and so as a result, analysis tends to have a fundamental focus or adopt growth-oriented theses. For example, a hedge fund betting on AI and GPU computing might buy 150 million in Nvidia shares while shorting 50 million in Intel shares, betting that Intel's weaker market position will lead to underperformance relative to Nvidia. Let's then say the tech sector rises and Nvidia's stock is up by 20% and Intel's is up by 10%. This results in 30 million in Nvidia gains and 5 million in losses from the Intel short position, resulting in a net gain of 25 million. On the flip side, if the sector falls and Nvidia is down by 20% and Intel is down by 10%, this results in 30 million of losses from Nvidia and 5 million in gains from Intel, resulting in a net loss of 25 million. As you can tell, the hedge fund is making a directional bet on both the company and the market, and so while they do limit their losses, there's still a lot of risk. Lastly, just so you're familiar with the long-short equity funds that are out there, some of the names include Tiger Management, Viking Global, Point72, Maverick Capital, and Lone Pine Capital. Next up on the list is the equity market neutral strategy. Even though this strategy also invests in equities, there are some key differences compared to equity long-short. As the name suggests, equity market neutral seeks returns regardless of the direction of the market. This means that after controlling for exposure to industry, sector, and size, returns should be uncorrelated to market movements. These funds do this by having roughly equal long and short positions, with short positions having similar characteristics as the long to cancel out the effects of market moves. Following with our previous example, a market neutral fund betting on AI and semiconductors might buy 100 million in Nvidia shares while shorting 100 million in Intel shares. In this scenario, if the tech sector rises and Nvidia stock is up by 20% and Intel's is up by 10%, this results in 20 million in Nvidia gains and 10 million in losses from the Intel short position, resulting in a net gain of 10 million. On the flip side, if the sector falls and Nvidia is down by 10% and Intel is down by 20%, this results in 10 million of losses from Nvidia and 20 million in gains from Intel, resulting in a net gain of 10 million as well. As you can see here, regardless of whether the market goes up or down, the hedge fund makes a profit, and the idea here is that market neutral hedge funds only get paid for their skill in finding good investments. If a hedge fund was getting returns because they had exposure to the tech sector overall, instead of finding underpriced stocks, investors could easily just buy a tech ETF with lower fees. The lower risk and volatility in this strategy means that returns are lower by themselves unless leverage is used, which hedge funds use to amplify returns, but the strategy overall is meant to be stable even when the market performs poorly. A lot of funds combine market neutral strategies with others, so this strategy is widely used across the industry, but some of the top firms that use it include Citadel, Millennium, AQR, Marshall Wace, and 2 Sigma. Next up, let's go into the strategy that is taking over the hedge fund world, Quant. Unlike traditional discretionary hedge funds that rely on security selection and fundamental analysis, quant funds use data-driven signals to generate returns. These strategies are rooted in financial theory, leveraging fundamental signals like value, quality, growth, and momentum, but their implementation is fully systematic, relying on computer algorithms rather than human judgment. Alternative data that's not available to everyone, like news article sentiment, credit card transactions, satellite imagery, and web scraping, are often used by quant funds to gain an informational edge. And after analyzing these massive data sets, trades are made across multiple asset classes like futures, FX, contracts, equities, and swaps at lightning speeds for seconds to minutes before closing them for a profit. And this is summed up by a term you may have heard of called high frequency trading. The skill set required for quant roles is far more mathematical and technical, and so instead of DCF modeling or deep fundamental research, quants need expertise in statistics, probability, machine learning, and computer science to develop and refine trading models. One of the most well-known quant funds is Renaissance Technologies, whose flagship fund, the Medallion Fund, is famous for generating an unprecedented return of 66% annualized before fees from 1988 to 2021, and others on the list include Citadel, D.E. Shaw, and 2 Sigma. Moving on, next on the list is global macro strategy. Macro hedge funds take positions based on macroeconomic trends such as inflation, economic growth, interest rates, government policies, and geopolitical events. These funds trade across currencies, commodities, and fixed income, but can also express macro views through bonds and equities. But since individual company fundamentals usually distort broad economic trends, macro funds often invest in ETFs, futures, and swaps rather than single stocks. To give you an example of a macro trade, a popular one in 2024 was the yen carry trade, where investors borrowed Japanese yen at ultra low interest rates to buy higher yielding currencies like the US dollar. This trade was profitable as long as Japan maintained near zero interest rates and the US kept rates high. But when Japan unexpectedly began raising rates, borrowing costs in the yen increased, making the trade less attractive, and the unwinding of these positions led to a sell-off in global markets as investors rushed to close their positions. This triggered volatility across multiple asset classes, and this was another lesson in that you never get a free lunch in the world of investing. The largest macro funds in the world include Bridgewater, Man Group, Garter Capital Partners, Brevan Howard, and More Capital. Next up on the list, we have strategies focused on credit and fixed income. These funds specialize in trading bonds and securitized products, including government, corporate, and municipal bonds, as well as collateralized loan obligations and mortgage-backed securities. These funds generate returns by setting up trades that reduce one type of credit risk while betting on mispriced securities whose prices are likely to change in the future. Within credit strategies, distressed debt is a specialized subcategory that focuses on non-investment grade debt, trading at steep discounts due to financial distress, restructuring, or bankruptcy. While these assets carry high risk, funds can profit by acquiring undervalued debt, influencing restructurings, and/or negotiating favorable recovery terms. To give you a real-life example, in the early 2000s, Elliott bought Argentina's defaulted bonds at a deep discount when the country was struggling, and instead of accepting the restructuring deal, Elliott pursued aggressive legal action in US courts and even seized an Argentine naval ship in Ghana in an attempt to force payment. After a crazy 15-year legal battle, Argentina ultimately settled in 2016, paying Elliott $2.4 billion, nearly 10x Elliott's initial investment, cementing Elliott's reputation as one of the most aggressive vulture funds in distressed debt investing. While almost all the large hedge funds are active in credit, some well-known names besides Elliott include Silverpoint, Cerberus, Anchorage, and Canyon. Next up on the list are event-driven strategies. Event-driven hedge funds aim to profit from temporary mispricings caused by corporate events such as M&A, restructurings, bankruptcies, and other special situations. These funds typically have broad, flexible mandates that allow them to invest across any asset class. For example, in M&A-driven event trading, merger arbitrageurs buy shares of a target company at a discount to the acquisition price after a merger is announced, but before it closes. This discount exists because of the risk that the deal falls apart due to things like regulatory issues or financing problems. And if the merger closes successfully, the fund profits from the spread between the purchase price and the final acquisition price. One of the other most well-known event-driven strategies is activist investing. Activist hedge funds take a significant stake in a company and use their position to pressure management into making strategic changes aimed at increasing shareholder value, oftentimes by rallying other shareholders and launching proxy contests to gain board control. One example of activist investing gone right is when Carl Icahn invested $1 billion in Apple in 2013 and pushed for buybacks and more, and ultimately exited a few years later with a $2 billion profit. And one gone wrong is when Bill Ackman and his firm Pershing Square invested in Valeant, which ultimately cost him and his firm $4 billion. And besides these two, the most famous event-driven hedge funds include Elliott, Third Point, and Farallon Capital. To wrap this all up, even though these are the main strategies, many hedge funds will use multiple strategies, and most of the largest hedge funds hold multiple investment teams or pods that invest in a different strategy. This diversifies returns since these strategies are uncorrelated, and each pod's performance and risk are closely monitored to see how they affect the overall firm. In the next screen, you're going to see a video about the good, the bad, and the ugly aspects of hedge funds. Feel free to watch that if you'd like as well. With that said, thank you so much as always for watching, and hope to catch you in the next one.